All right, today I'm going to cover a stock that I don't particularly like, that I was trading all the way back here in early 2021, all the way through most of 2021, because it did have some nice premium going through this stretch right here. My final put, I got stuck right here on my final put and it just never recovered. I got assigned at 28, just never recovered, and it's been in this trench around, hovering around 20 ever since. Recently, we've had this upswing in May with the market, and then that's teetered out a little bit, and we're hovering around 28 again. Look at this absolute dead, absolute dead uh, chart here. I mean, this is a few weeks, and it's just hovering around 28. Let's go back a little bit more. Yeah, so right here in June, it had a little run up, and it's just been kind of dead since June. So, why do I care? Well, check this out. I got DBX 100 shares at 28. Sold a couple covered calls on this, not many. I still have a covered call out there for October 28th of 2023. And I don't want that. I don't want this position anymore. So what do you do when you don't want a position anymore? I got a covered call against it. This is what it looks like. I bought 100 shares at 28. I have a covered call against it. I think it, yeah, I think it's that call. And then let's take a look at this strategy. Covered call strategy. Max loss is 27.28. That is the premium I received minus all of the stock. If this stock goes to zero, I'll lose 27.28 and keep, or 27.25 and keep the premium here. But I don't want close to 3,000 or 2,800 on the line anymore. So what do? Well, you do a poor man's covered call. Now, some of you may have heard those before. Instead of keeping the stock, let's say I want to sell the stock, then you, instead of buying the stock, having the stock, then you buy a call, say January, for deep in the money. So let's say 25. So I'm buying a call at 25, strike price 25 for January. So I can keep this 28 open here. Now, you could just say, why don't you just buy back this $75 here? Well, here's the thing. This is a bullish strategy. If this goes up, then I can sell this and this will get triggered and then I could sell this for a profit. So this is a bullish strategy and I do want this $300 back, but I don't want all 3,800 tied up. So let's look at this. So my max loss is only 335. That's if the covered, or the call I bought expires out of the money, and then the max profit is infinite because the market, the stock could go up. If the stock goes up to 50, then I made a massive profit. Brought down my break even to 27.44. Remember, I have a cover call at 28. So infinite max profit, max loss is reduced heavily. This is the poor man's covered call. So what do I want to do? Well, what I want to do is I want to trade. I want to go to my January 2024 and I want to go to the 25 right here and I want to buy it. Let's say I buy it for 400. Confirm and send. See, the buying power effect is only 259. Hit that. That triggered. And now what I can go ahead and do is I can go over here to my Dropbox and I can create closing orders, sell right there at 27.80, and I could get my close to 2,800 back. And then I'll have that call sitting out there. It's technically a call debit spread, but it's also called a poor man's covered call. So that is my strategy. I got this sell order here for Dropbox. Sort of break even on that. I'm just not a bull anymore on that. I have this call out there, and then this call out there. This one I own. This one's I'm short on. So that's my debit spread or my poor man's covered call, and it only cost me $400 instead of keeping 2,800 out there. So that's my strategy.